Greetings, this is Dr. Jeffrey Scott, and welcome to my weekend market update for June 5th, 2022. My email address, if you're new to me, is hgsidoc@gmail.com. For those that are new to the YouTube site, hit the subscribe button, hit like if you like this, and hit the alarm, and you'll get notification when I post this. Please feel free to put comments in the remarks, or you can email me at hgsidoc@gmail.com. Disclaimer, as always, is for education purposes only. Any recommendation in the spirit of education should not be considered investment advice. I'm a doctor, not a broker. I demonstrate the tools that I use, and I've paid for these tools. Trading involves risk, and you alone are solely responsible for any investment decisions you make. If you like these videos, I post a shorter version every day at stocksanddocs.com. My team posts them in the morning. I record them either late at night or before work on the morning of the video. And I'm building a sort of a business around busy professionals. And I've got a couple of partners, and it's about how we manage working a busy business, but still managing our portfolios and hopefully making money at it. So if you like this video, but you want it in 6 to 10 minutes, go to that site. And remember, they're updated in the morning by one of my business partners. All right, so that's the intro. I like to put a lot of stuff together in this spreadsheet so I can get a quick sense of the market. Today I'm going to try and do this quicker than normal, so 30 to 40 minutes, not an hour and a half. And so I'll do less teaching and more commenting about the market. If I look at 52-week interval from the 52-week high, we are still in bear market territory as the Nasdaq is down 25.9. On the composite, it's down 25.1. On the Qs, no surprise, the Qs make up the majority of the Nasdaq from the weighting perspective. The Russell's down 23.5. The S&P is not in a bear market, 14.5, but it's in a correction, and the Dow similarly down 10.9. If you want to know what a crash is, take a look at Bitcoin, which is down 65% off the 52-week high. Yeah, sorry to say that, 65%. ARC Innovation, Kathy Wood's growth is off 67%. If we look at over the last 5 days, but because Monday was a weekend holiday, this would be including the prior Friday, you can see a lot of green. But as you very well know, and you don't need me pointing out, Monday was a challenging day. Friday was a challenging day in the markets. Monday was a free day in the market. If we look at the sectors, the only sector that was up on Friday, shocker alert, is energy, which has been leading for some time. And if you look over the last 5 days, it was up 3%. And if you look at off 52-week highs, communications down 31, discretionary 28.9, and technology down over 20. These are things that you would want to leave the market. And when these markets are leading to the downside, that just tells you the markets we're in. Now, when I look at some of the breadth things, this is from the Q tools, and I look up at the top, I can see that on Fridays, 91% of the sectors were down, 89% of industry groups were down, and 81% of stocks were down. Your portfolio, if you're long, was probably down. I'm a top-down guy, and when the markets are down, typically it brings down the stocks that you own as well. Down here, you could see that 2 weeks ago, everything was green, and we had 100% of the sectors up. And it's really a one-day deterioration. So was this just a bump, and it was news-driven with the employment numbers perhaps being more hawkish than people expected? Are we going to continue the uptrend? I think we're not done with this bounce, but I don't know that for sure. I do think we're in a bear market, and we're seeing bear market bounces. And as I've said 1,000 times, these things have a tendency to fail. Again, why do I feel more bullish on the market? Because when I look at the performance on the left, the charting ERG, which gets greater to the right. ERG is a combination of earnings growth, relative strength, and group rank. The higher ERG with a higher performance, the lower ERG with a lower performance, it tells me growth is probably working. High EPS rank was positive, everything else was negative. Interestingly, high relative strength was positive, but so was very bad relative strength, so junk off the bottom. And, overall, I think the market was probably weaker than this graph looks like. The Nasdaq, I don't expect to see the Hindenburg Omen again for 2 years. We have to get to new highs. But the weekly bongo is something that I developed with some of my colleagues, and that is my long-term trending indicator. When it's red, it's a no-go looking at the longs. Doesn't mean you can't play some things to the long, but if the weekly bongo is red, it's red on the Nasdaq, it's telling me that I'm a counter trend trader and it's hard to make money trading against the trend. If we look down here, and I didn't color this in, so I color in when it's more than 2% up or down. So let me just color these real quickly when we're talking. So the bad news here is we've got some, we've had a couple of the new low bars actually break above 2%, and we still don't have many new highs. So I think this rally in some ways has been a seller strike where people stop selling. It's not because of buying on the Nasdaq. And again, the Nasdaq down 2.3% on the week. If I look at the NYSE, ditto. I should color this because I usually do, but interesting, I'm only going to color on this side. So the NYSE actually looks stronger. And same story. I colored it too dark. Let me try that again. And I just do this spreadsheet because it's something that I'm kind of anal and I track every day and been tracking it for years. On the NYSE, you're still in a weekly bongo, so any long trades be a counter trend trade. We're starting to see some new highs. So perhaps the NYSE is diverging from the Nasdaq, and there's some buying going on. Think about it. NYSE is heavily built miners and oil and very little tech, and the Nasdaq is tech and very little miners and oil. My bucket analysis, still very bullish on Friday. 80% of the stocks are above the midline of their Bollinger Bands. This plays to the argument that Friday was a short-term hiccup. And if I look at where the stocks are within their bucket analysis, we have no stocks below the buckets and very few above, very neutral. So to me, this is more bullish than bearish. If we look at energy, energy's been leading. And if you look at energy weekly, the only thing that was down was naphtha and some of the European and gas. But if you look at oil up 3 to 4%, natural gas was down a bit on the week. We've talked about the volatility, heating oil up 9.6. Uranium was strong. If we look at metals, we can see that on the week, steel was down, but big move up on iron ore, and I saw that on Techminco at the end of the week, one of my larger holdings that we've talked about before. The thing that really killed me and then didn't kill me was the volatility in lithium. It was like natural gas. And somebody came out and said in an analyst report that they thought the spot price of lithium would drop 85% in the next year. So if you own Albemarle like me or SQM like me, you got punished. But I'm not sure I buy that argument. If you look at Baltic Dry Shipping Index, it's turned up at typical support, and that supported some growth in those. Interest rates, no surprise in white, the 10-year and the 30-year both trended up, and that's what's driving the market in yellow down. There is no issue on credit right now. In fact, the options adjusted risk spread here actually came down some. I watched this closely. You could see what happened before the market rolled over in 2020, and that's a yield inversion right now. It doesn't mean anything. Overbought, oversold. We can see the stocks above the 200-day, stocks above the 40-day, both improve. So that's a bullish signal on the week. And stocks at a 13 new week, new high low came down some, but are sort of in a neutral area, not overbought or oversold. From a news perspective, Monday's light, good thing because I'll be traveling. And when I looked at this, the jobless claims on Thursday are important, but I think the CPI monthly and year over year is going to be big market driving, just like employment was this Friday. It'd be nice to see some easing of the CPI, and that might give the Fed the excuse to start at least talking about taking the foot off of the accelerator. Looking at earnings releases, not much for me to say here, except there's not many. It's a judgment call to hold earnings over their earnings dates. It's just bad judgment to not know when your earnings date is. You have to know what you have and know their charts and when their earnings dates are. Expected moves, not going to say much about it this week. Last week was pretty impressive. For the most part, the markets traded within their expected moves this week. So it was a good week for the option market makers, and it just shows it was a quieter 4 days than the prior week when almost every major index was broke out of its expected moves. My thoughts: markets trade mostly lower, but within the expected moves. According to IBD, we're in a confirmed uptrend this week. We saw some distribution, however, and it's a bear market rally until proven otherwise. Just going back to number one, remember the 5 days includes a week ago Friday, which was a super strong day. The Fed speakers seem to contradict the concept of pausing as employment was strong. EPS reports are slowing down, but they still matter. News, CPI, we mentioned. Lots of strong charts in energy, but for the most part, hard to find great setups. And then this is sort of my criteria, which is William O'Neill's investorsbusiness.com criteria for knowing that we're not just in a bounce. We've checked off one, but we still have a lot to go before we want to think about this being a meaningful rally. Don't forget, Simon, this is for you, that the market will bottom and start heading up before the economy is done going down. And this week reminded me of the fragility of bear market rallies. All right, let's go look at stocks. So now, the next thing I'd like to go into is look at charts. And let's just go look at the major indexes and see if we can make some comments. Blow this pop up and look at the S&P 500, the spiders. Is that sideways or not? So we're consolidating after a move up. That is extremely healthy. Now, what is good news and bad news is you could argue that we're building a platform for the next move up. What's bad news is this 50 days going to come down and run into this flag very soon. So I'd like to see a breakout on volume very quickly from this sort of a flag. But you know what? The more I look at it, the more I'm thinking the market can still go higher here. No guarantee. Just approach the market with a clear and open mind each week. Q's the same, Diamond's the same, the Russell the same. So the markets are acting in concert. If we look at the VIX, if you're bullish, you want to see this to stay down. It did. And the dollar, I've talked for weeks about it. I'd like to see the dollar come down. And the dollar's just bouncing on the 50. So it's met that criteria. Further coming down will probably be accompanied by rates coming down as well. If we look at some of the commodities, the dollar stays up there, gold doesn't, and you can see gold and silver are going sideways at best. The 10-year came down, bounced off the 50, and has bounced higher. That's let me think, that's probably my EMS signal, and I forgot to make it into a diamond or a triangle, so let me fix that. The EMS signal is a proprietary indicator that I made, which is it's a trending indicator, and it's relatively fast. And so it will fire before some of my other signals, and it'll get you in and out. And you could see sell here, buy here, sell. So nothing's perfect in this world, but it's going to get you in close to a bottom. And the fact that it's now going up tells me rates are probably going higher. Market theme remains a story of large caps when we head this way, and value. What's large cap value? Defensive stocks. Now, just to look at it on a shorter term basis, there is a hint that we're heading down. And remember, when this is heading down, it favors small caps. When it's heading up, it favors large caps. This is an hourly short term. So clearly coming into the end of the week, we had some favor of small caps. Heading down on the hourly chart or the daily chart means you're favoring value. Running up, you're favoring growth. So here we have some evidence of small cap over here heading down and growth actually improving. And I mentioned before, I believe that the IBD 50 was actually up Friday when most of the major indexes were down, and that is small cap growth. If we look at the sectors inside the S&P 500, what I'm looking for, these are ratio charts, so I'm neutralizing individual numbers and comparing them to the S&P 500. And what I want to do is find what groups are up at the top. And it's materials and it's energy. Boy, it's been energy forever. It's for so long. Looks like industrials, XLI, is showing a little bit of life. And I'm really disappointed because typically during this ASCO meeting, healthcare goes crazy, and it's not. So the leadership has been materials and energy. If I go into my dashboard, and I'm just going to mention what I do, is I do what's, as a top-down trader, I try and identify what industry groups are moving. Healthcare, energy, industrials were 3 of the 4. The 4th one was materials. Materials had a weekday on Friday, but if you look at the weekly performance and not the daily, it's healthcare, energy, materials, and industrials. The same things we saw in the short term ratio charts in the S&P 500. So what I did is I took these 4 groups, I hit compare, and I bring up the industry groups in there, and then I ranked them by performance, and I wanted to go deeper into each of the industry groups that was positive on the day or the week. And we'll just drive this down here. Let's go down to here. And then I hit compare, and this brings me up the stocks. And then I just use the algorithmic daily algo score, and I took all the stocks down to about 750. And I've already done this once, but I'm just showing you hit that. Whoops, I hit the wrong one. Let me try this again. All right. I want to make sure I'm not getting all that. And I'm going to go down to the 750. Yeah. All right. I've got to reset this. All right. What I did is I took the top stocks. I actually hit something that I didn't want to hit, and I've got to go back, which I don't want to do right now. And I dropped the top stocks into a watch list that I call Weekend Review. Let's just go to that. Wealth Scanner is a tool that, again, uses algorithmic, artificial intelligence, machine learning to help tell me what industry groups using math came to the top instead of charts. And if you've been watching me for any time, it's always natural gas, gasoline, energy, commodities, oil services, oil producers, and then utility, short bonds, and dividend stocks. So it's really been a story of energy for quite some time, no matter which way I look at it. Here is natural gas, and I talk about the volatility. Imagine if you bought natural gas on my birthday, which is back here in January. You would have bought in at about 17, and it's ran up to just about 32 in 5 months. That's a pretty big move for natural gas, which in many ways was dead for a long time. Now imagine you're crazy, or you're me, who's a little crazy, and you decide you want to trade some oil. And you looked at oil, and if you had bought oil as late as, let me make that go away. What does it say? If I can actually see that, would be help. If you bought oil when it broke up, oil here when it broke up, which in March 21st, oil was at 44 and it's ran up to 138. But look at the volatility in this instrument. But the cool thing is it behaves. And why do I say it behaves? Because if you draw a trend line, it jumps up when it hits your trend line. So buy off the trend line. That's what I've been doing. Let's jump into my CAT scanner. Let's use it here. So the CAT scanner is a tool that I developed and had made for wealth charts, which is what I'm using today. And the whole intent is to make my life easy. So the weekend review is my bullish watch list that I put together. And I'm going to look at just stocks that have bullish dots. Remember, my dots are breakout, momentum, volume, and gap. And I like 5 and 500,000 size. And the cool thing is there's 8,000 stocks in the market, and I'm just going to look at the top 3 or 4. ACAD is a healthcare stock. I think it might be in the neuropsych space. not one that I know much of. And this is what stocks look like today. They look like stocks that have come down to, in this case, a double bottom, are bouncing around the bottom. They had the EMS signal come in on Thursday, a very strong day Friday in a weak market with three dots. These are volume, breakout momentum, out of a squeeze, improvement relative strength. ACAD looks interesting. I always want to know more about why it fell. ALK is Alaska Airlines. This is the pattern that you're going to see over and over again. Beaten down stocks, bouncing three dots and a squeeze. ALNY, Allen Pharmaceuticals, this is the same pattern. Now, if this stock is going to be a long-time winner, this stock is going to start heading north. And it's going to take out all this resistance and overhead supply. But there's also a high chance that it's going to fail at that. So I would be careful with all these beaten down plays. That's not to say that one of them or two of them are not going to be major performers. Now, I can look at just oil, gas, and coal and see if anything looks interesting. And the problem with oil, gas, and coal is for the most part, they've run already and they're extended. Here is one that is not. Don't know anything about HUSA. I think it's a natural gas play. And this one is breaking out, but it too has been beaten up. And I never love the pattern of the run up and run down. Usually it's a manipulated stock. It's a cheap stock. One of my favorites has been APA, and this is a great pattern. Stocks have broken out and are running. They're just higher risk. And if you look down here at my high-low oscillator, when you won't find anywhere else, the way that I do it, it's at 96%, which tells me it's pretty extended and one that's at higher risk of failing. I'm interested in biotech, and so I might come down here and look at biotech. And to be honest, it wasn't much. That ACAD continues to be the leader, but I don't want something that's sold off. I must have had 15 emails from friends. Jeff, you're at ASCO. Give me a tip. What company is going to do well? Well, here's the bad news. My business works with a lot of healthcare companies, and I've got non-disclosure, so I can't tell you. But if there's a company that I don't work with that I'm pretty interested in, it's just me talking. So this is LEGN. If I did it right, LG. I thought that was. Let me double check the ticker. LEGN. So I can't spell this hour. LEGN. Legend Biotech. You notice how this one looks totally different than the others. It's now broken out above resistance. You notice you don't see anything higher than this until you go back to January. So this is a stock that stubbed its toes. My interpretation of the data at ASCO is they had some of the best data. That means the stock could gap this week, but I see a breakout above resistance, strong relative strength and volume, and notice my high-low indicator at 33 says the stock is not extended. Now, I have a list of stocks that's pretty long that was interesting. Doesn't mean that's a buy list, it's a watch list. So let me just bring it up here and see if anything comes to the top. ACAD we've already looked at. Alt Immune is another biotech stock. And it kind of looks like the last one, doesn't it? Hope I don't have an internet problem. Let's see what happens here. Okay, back to Altimmune. So Altimmune is in the category of ACAD of a beaten up. And look, biotech, all right, IBB, the Nasdaq Biotech ETF. This is what biotech looks like, all right? So if something looks a whole lot better, that's pretty outstanding. But ACAD looks like that. And that was one of my top stocks, ALT. Anything else? I'm just looking through anything else that I want to point out. We looked at HUSA. And then VTNR, when we looked at a couple weeks ago, I said it was flagging by the breakout. It's broken out. I think that the way I was taught by my mentor, Ian, Here's the flagpole. So the flagpole ran from around 9.5 up to say 15, so that's $5.50. That you probably got 60% of that, so another $3 or $4 on a $16 stock. That's another 20% move. I like VTNR as well. I'll be watching that. So have an outstanding week. I haven't looked at futures yet. Hopefully you'll get this tonight or early in the morning. And here's your cup and handle. Here's your breakout. Big move up. Here's your flag and a breakout from the flag. So if I got to put it all together, that Legend Bio Pharma or Biosuit, whatever it was called, biotech, looks really interesting based upon data. That is a, what's the word I would use? That's buying on fundamentals. I'm a technical guy, but the chart also looked okay. And then VTNR's got the second best chart. And then if you're looking to buy something on the cheap, ACAD or ALT have both pulled back and look interesting. Not recommendations to buy. How could I know what your position size, your count is, your net worth, etc.? Just some ideas from my review. Have a great one.